Welcome to the Real Estate Way to Wealth and Freedom podcast with Jacob Ayers, providing actionable content to help you along your journey to financial freedom through real estate investing. As the premier asset class, real estate has helped ordinary people just like you amass fortunes. The benefits of passive income from real estate investing will allow you to live a life you want. And now your host, entrepreneur, real estate investor, and apartment deal syndicator, Jacob Ayers.
Hi, and welcome to the Real Estate Way to Wealth and Freedom podcast, episode 211. Hi, I'm your host, Jacob Ayers. Thanks so much for tuning in to this week's episode. You are listening to another episode of Friday Fundamentals. Hi, and welcome back. Well, hey, if you listened to last week's episode, you can probably tell I'm still getting over a bit of a sinus infection here, so my voice probably sounds a little bit off, but that's not keeping me from jumping on the microphone and bringing you another episode of Friday Fundamentals. So, without further ado, let's jump into it. This week's Friday Fundamental is how to analyze a market. When looking at real estate investing, there are a lot of things one should look at. Property type, age, construction type, deferred maintenance, value add opportunities, etc. But none of those is the most important factor. The three most important factors with real estate are location, location, location. Okay, I'm sure that's a joke some realtor has heard way too many times, but nonetheless, it's true. Location is the only thing you cannot change with the property. You can fix it up, tear it down, repaint it, change the use, and pretty much anything else, but you can't change the location. This is why it's important to select the right location of a property before looking at any other factor. So let's look at how to evaluate this. The location of a property is the market, and markets can be broken into submarkets and even neighborhoods. Not all properties in a state are created equal. Not all properties in a city are created equal. Not even properties in the same neighborhood. Think of your market. There are probably areas where on one side of a street is much different than the other side. The same thing applies pretty much everywhere. So let's look at some important factors when evaluating a new real estate market. Now, when evaluating a market, we're concerned with two areas: demographics and economics. Essentially, who lives there, how many people live there, and how much money do those people have. The first factor we look at is unemployment rate. The unemployment rate is important to you as a real estate investor because people need jobs to pay rent. But digging deeper, we're concerned with more than just the current unemployment rate. We want to see a positive trend or a lower unemployment rate. If fewer people are unemployed, that means more people have jobs. Simple, right? Great, so we'll look at the unemployment rate trends and make sure this number is declining over time, typically the past 5 years or so, or at the very least it is staying stagnant. 2 is population growth. The population of the market is important because, well, you need people to live in the market to rent your real estate. Just as with other criteria, we're looking at trends. We want to see an increase in population over time, not a decrease. If more and more people are moving into the market, that creates a demand for places to live. So far, all this is pretty simple, right? Now, next is population age. This is another factor that will tell us what's going on in the market. Think of who fits the demographics of an average renter. Typically, those are younger people and elderly people. You can look at the age of a population and see what percentage falls into those typical renter pools. And then we want to look at job diversity. Having many different employers or industries in the market will ensure that no one employer or industry can go under, move locations, or lay off their workforce, single-handedly impacting the market. Think of an area that is dependent on one industry or company. Let's take Detroit, for example. Not to pick on Detroit, but a famous case study here. When the auto industry moved jobs and production to other countries, Detroit's economy took a serious hit. Now, ideally, we want a diversified market so that no one industry has to support economics and jobs. And 5, supply and demand. Simply put, supply is the amount of real estate available, while demand is the amount of real estate needed. If the market has 1 million apartments and only 800,000 people, then it is in oversupply. Vice versa, if a market has 1 million people and only 800,000 apartments, then the market is in short supply. This, of course, is a simplified explanation, but you get the picture. And then lastly, the miscellaneous things. Here we look at things like property taxes, cost of living, landlord-tenant laws, etc. These are mostly things that people consider when moving to the market, so it's important to understand them as well. Now, if you consider these things when selecting a market, you'll be well prepared to make an informed decision. And all of this information is readily available on the U.S. Census Bureau at census.gov, which is linked in the show notes here. Now, while your property you select must be in a good market, that alone is not enough to ensure it is a good deal. As Joe Fairless outlines in his book, The Best Ever Apartment Syndication Book, which I highly recommend, by the way, there are 3 immutable laws of real estate investing. 1, buy for cash flow, not appreciation. 2, secure long-term debt. And 3, have adequate cash reserves. If you couple these 3 laws with selecting a strong market, you have a recipe for a successful real estate investment. Now, just like everything else, there is risk involved when investing. This much you know. The best hedge against risk is education, though. So learn as much as you can. Implement what you learn and take action. Use resources like Joe's book and others, podcasts, real estate conferences, and networking to leverage other people's experience. Do these things, and you'll be well on your way to building a real estate portfolio that gives you the wealth and freedom to live the life you want. Well, that wraps up this week's episode of Friday Fundamentals. Hey, I hope you're getting value from this show. If you like what you heard, please go over and leave a rating and review on whichever platform you're listening on. And as always, if you have any questions, comments, or would like to reach out to me personally, you can do that at www.jacobayers.com. Till next week, engineer the lifestyle you want.
You've been listening to the Real Estate Way to Wealth and Freedom podcast, providing you actionable content to build your real estate empire. Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for personal advice. The opinions of guests are their own. Information is not guaranteed. All investment strategies have a potential for profit or loss. The host is operating on behalf of the Real Estate Way to Wealth and Freedom, LLC, exclusively.